Hawaii has one of the lowest foreclosure rates in the entire United States, 40th lowest out of 50 states, according to the property data firm ATTOM, about 1 in every 6,453 households, against roughly 1 in 758 nationally. If foreclosure risk is how you'd price the danger of owning a house somewhere, Hawaii should be one of the calmest markets in America. It isn't. Hawaii home sales just fell to their lowest level since 2009. Prices, at the same time, keep climbing. Those two facts shouldn't sit together this comfortably. The University of Hawaii Economic Research Organization looked at that gap and described residents facing, in its own words, impossible choices, leaving the state, making do with substandard or overcrowded homes, or falling into homelessness. The same report ties that squeeze to a shrinking labor force. People aren't just struggling to buy here, some of they are leaving. By the end of this video, you'll understand why a market with a reassuringly low foreclosure rate is also the market UHERO says is squeezing its own residents out. And you'll understand the 4 bills that actually decide whether owning a house in Hawaii works, none of which show up on the listing, the inspection report, or the closing statement. 2 of them you inherit from the land itself. 1 of them your insurer decides, sometimes with no warning. 1 of them your neighbors vote on, whether you like it or not. Start with the number everyone already assumes, the price. On Oahu, the median single-family home sold for $1,160,000 in March 2025, according to the Honolulu Board of Realtors, up 5.5% in a year. A condo, statewide, carries a median of $500,000. Maui County runs close behind the single-family number, around $1.2 million. Kauai and Greater Honolulu sit near $1.1 million. The priciest zip code in the state, Princeville on Kauai, posted a median of $2.3 million across 45 sales. Hawaii County, the Big Island, breaks that pattern. Prices there run far lower than the rest of the state, and they split in 2. The Kona Coast trades close to Oahu money, while the Puna and Hilo side sells for a fraction of it, according to UHERO's 2026 Housing Factbook. The cheapest houses in the state sit on the island with the most active volcano in it. Keep that pairing in mind. It matters later. None of that is the surprise. The surprise is the commission. It averages 5.51% of the sale price, per a 2025 survey by Real Estate Witch, 2.73% to the listing agent, 2.78% to the buyers. On that $1.16 million Oahu home, that's $63,916 before either party moves a single box. Closing costs stack another 0.6% to 2% on top. Then there's the property tax bill, and this is where the state starts sorting its buyers. Occupy the home yourself, and Kauai charges $2.59 for every $1,000 of assessed value, about $2,900 a year on a median home there. Live somewhere else and rent that same kind of house out long-term on Oahu, and the portion of value above $1 million gets taxed under what the county calls Residential A, $11,40,000 per $1,000, same house, more than 3 times the bill. You never touched a single physical thing about the property. The county is taxing what you intend to do with it, not what it is. That intention, rent it out, is the plan for a lot of buyers here. And the math looks reasonable. Statewide, short-term rentals average $406 a night at 42.6% occupancy, according to the data firm AirDNA. In Lahaina specifically, post-fire scarcity has pushed that to $1,272 a night at 63% occupancy. 2 problems sit under that number. First, on Oahu, you likely can't legally do it. In 2022, the county passed what's known as Bill 41, phasing out most whole-home short-term rentals outside a handful of resort-zoned areas. The restriction was aggressive enough to draw a federal lawsuit and an injunction from Judge Derek Watson before enforcement went ahead. If you're buying on Oahu to run nightly rentals, check the zoning map before you check the listing photos. Second, even where it's legal, the state and county take a bigger cut of that income than the sticker suggests. The combined general excise tax and transient accommodations tax, which is Hawaii's version of a sales tax stacked on top of a hotel tax, runs about 17.75% in 2025. It climbs toward 18.7% in 2026 as the accommodation tax rises to 11%. On Maui, if the county classifies your property in its short-term rental tax tier, the property tax rate itself jumps to $13 of value, against $2.90 for an identical home rented long-term. The income meant to cover your mortgage gets taxed like a hotel room. To 3 different governments, that's exactly what it is. Here's the part almost nobody explains before closing. On a meaningful share of Oahu, you can buy the house and still not own the ground it sits on. It's called a leasehold. The land underneath the home belongs to someone else, usually a large legacy estate, who leases it to you for a fixed term, decades long, at a rent that resets on a schedule the landowner controls, not you. Bishop Estate alone has historically held roughly 14,000 leasehold house lots, plus the leased land under close to 13,000 more condo units, concentrated in neighborhoods like Kahala, Hawaii Kai, and Kailua. When a lease approaches its renegotiation date, the landowner can reset the rent to current market rates. On a condo, that renegotiation can reprice the entire remaining value of the unit downward. What you're actually holding in that structure is a shrinking claim on someone else's asset, not a growing one on your own. You can pay the mortgage on time, maintain the unit, never miss an association due, and still watch the thing you thought you owned get repriced by a landowner's decision you had no vote in. Even fee-simple land, where you do own the ground outright, isn't a clean escape from access problems. Upcountry Maui currently has more than 1,000 households on the wait list for a water meter. That wait can stall construction, or a sale, indefinitely. You can own the dirt outright and still not able to build on it. Here's the one that touches almost everyone reading a Hawaii listing right now. Leasehold or not, short-term rental or not. Insurance. Statewide, insurance non-renewals rose roughly 216% between 2018 and 2023, according to State Insurance Division data reported by Hawaii News Now. That the trend sharpened hard after the Lahaina wildfire in August 2023. By January 2026, named carriers were posting increases like these. State Farm up 28.5%, with some policyholders seeing as much as 48.4%, Dongbu up 65.4%, Allstate up 62.1%, Liberty Mutual up 56%. Insurers are deciding, policy by policy, that Hawaii risk costs meaningfully more than it did 3 years ago, and in a growing number of cases, they're deciding not to write the policy at all. Buying on the Big Island in a designated lava zone lowers the ceiling further. The Hawaii Property Insurance Association, the state's insurer of last resort, caps coverage in the highest risk zones around $450,000 and doesn't offer hurricane coverage there at any price. 2 owners make this concrete. Lahi Heen, a 64-year-old bank teller in Hawaiian Shores on the Big Island, watched her premium climb from $1,500 to $5,000 in a single year. She borrowed roughly $30,000 to pay off her mortgage early. Not to save on interest, but because paying off the loan was the only way to escape her lender's insurance requirement entirely. Andrea Rosenoff and Stephen Sparks, living on Social Security in Leilani Estates, in the same lava zone where the 2018 Kilauea eruption destroyed more than 600 homes, now pay $5,900 a year for a maximum $350,000 in coverage through that same state-backed association. No private insurer will offer them hurricane protection at any price. In August 2024, Hawaii's governor issued an emergency proclamation over the state's home insurance market. Strip away the corporate language, and this is what it means. 2 households paying thousands of dollars a year for coverage that, if their home was a total loss, still wouldn't fully replace it. That same insurance collapse doesn't stop at single-family homes. It's hitting condo associations even harder, and this is the bill your neighbors can vote to send you. When an association can't find enough private insurers willing to cover an entire building, the cost of whatever coverage remains gets split across every unit owner. When the gap is too large to close with a premium increase alone, the board can levy a special assessment, a one-time bill, sometimes running into 6 or 7 figures across a building, to cover what insurance no longer will. Hawaii's Department of Commerce and Consumer Affairs has been documenting this pattern in its condominium bulletins since 2024, premiums doubling or tripling associations stacking coverage across as many as 15 different insurers just to reach the total a single carrier used to provide. The state's response tells you how serious the shortfall is. In July 2025, lawmakers passed Act 296, creating a state-backed loan program specifically so condo associations could cover insurance costs the private market would no longer underwrite on its own. A state legislature building a lending program because insurers are simply declining to participate is not a pricing dispute. It's a market failure, and the bill for it lands on whoever owns a unit when the vote happens. Notice how the earlier tax penalty and this assessment risk stack on the same owner. Rent your Oahu condo out long-term, and you're already paying the higher residential A tax rate. Get hit with a building-wide special assessment on top of that, and the unit that was supposed to generate income is now costing you twice, once through the county, once through your own association. One case ties all of this together, and it's worth sitting with. Mikey Burke, a native Hawaiian mother of 4 and a Hawaiian Electric employee, lost her $761,645 Lahaina home in the August 8, 2023 fire. By July 2025, nearly 2 years later, she owed $71,000 in missed mortgage payments, after missing a $30,000 housing grant because she couldn't respond within its 5-day window. She is not an outlier. Of 257 surveyed Lahaina fire households, 78 were at foreclosure risk as of last August, and Rocket Mortgage alone holds more than $46 million in mortgage debt tied to homes that no longer exist. A fire doesn't erase what you owe, it just starts a foreclosure clock running in parallel with the insurance claim. Which brings us back to where we started. Hawaii's low foreclosure rate isn't fully reassuring, and it isn't fully misleading either. It's genuinely complicated. Foreclosures here take an average of 1,760 days to complete, the slowest in the country. So a lot of financial distress sits unresolved rather than showing up in the completed foreclosure number at all. That doesn't make the risk smaller. It just means the risk shows up somewhere other than where you'd think to look for it. What does show up, plainly, in UHERO's own numbers, is home sales at their lowest level since 2009, just 6,573 statewide last year, in a market where prices keep rising anyway. Enough buyers have started pricing in the bill that arrives after closing, the leasehold reset, the insurer that won't renew, the assessment vote you don't control, that fewer of them are willing to sign at all. None of these 4 bills is unique to Hawaii by itself. Coastal insurers are retreating in Florida too. Special assessments are hitting mainland condo boards. What's unusual here is that Hawaii is running all 4 at once, on top of the highest home prices in the country, and that combination is why sales are stalling even as the number on the sign keeps climbing. The house is never the whole price. In Hawaii, it might be the smallest part of it.